Welcome to Global Investment Insights, a weekly podcast brought to you by ADCB Asset Management. My name is Kishore Muktinutalapati, Head of Investment Strategy. With an objective to empower you with investment insights, on this program we discuss various perspectives that are shaping the global investment landscape. In this episode, we review macro trends and market performances during the first half of 2023 and discuss how investors should be positioned for the second half of the year. Starting with the macro picture, economic growth was surprisingly resilient during the first half of the year. We did not really see the global recession that was widely anticipated. By region, US growth was resilient, helping the global economic mood. Japanese growth remained strong too. However, the final Q1 GDP print for the Eurozone was revised down to negative 0.1% quarter on quarter, officially marking a technical recession. Job markets remained strong across the developed world. Turning to emerging markets, Chinese recovery continued but turned out to be slower than expected during the second quarter, following a sharp rebound in the first quarter. Other emerging markets continued to prove resilient in their growth prospects. Looking at the activity sector-wise, manufacturing activity remained weak, yet the strength in services sector compensated. Turning to inflation, price pressures continued to normalize broadly. While the headline inflation continued to moderate, core inflation proved to be a bit sticky, particularly in developed markets. Especially in the Eurozone and the UK, core inflation remained stubbornly high. In the US, core inflation was primarily driven by the services, which include shelter. On the back of this growth inflation dynamic, central banks continued to increase interest rates. The US Fed, the European Central Bank, and the Bank of England have all raised their policy rates over the past 6 months and continued to strike a hawkish tone. Emerging market central banks, being ahead of the game in terms of raising rates, continued with a less hawkish bias. While the central bank tightening has been a global phenomenon, there have been two notable exceptions: the Bank of Japan and the People's Bank of China. While the Japanese central bank maintained its easy monetary policy, Chinese central bank in the recent weeks has turned more supportive of growth. Against this macro backdrop, financial markets performed rather well. Global equities, as measured by the MSCI All Country World Index, delivered gains of circa 14% in the first half of the year. This was the second best first half performance for equities in almost 25 years. By region, the US outperformed by 3 percentage points while Canada and UK underperformed. While Asian equities delivered gains, they underperformed global benchmarks. By global sectors, gains were concentrated in information technology, communication services, and consumer discretionary. Energy and utility sectors not only underperformed but also posted losses in absolute terms. Turning to the foreign exchange, the trade-weighted US dollar fell, albeit only marginally over the past 6 months. The US dollar fell against the euro and the British pound sterling, but rose against the Japanese yen. Within commodities, oil prices fell more than 12% over the past 6 months. Amongst industrial metals, aluminum prices fell more than 10%, while copper prices were largely unchanged year to date. Within precious metals, gold prices rose while silver and platinum prices fell. In the fixed income space, global aggregate bond indices posted small gains but significantly underperformed equities. In the sovereign space, yields on 10-year US Treasuries and 10-year German bonds fell, while yields on 10-year UK gilts rose sharply over the past 6 months. Just as a reminder, when yields rise, prices fall, and vice versa. Looking ahead, we believe the equity market outperformance relative to bonds will continue. However, we do not rule out the return of market volatility over the next 2 months as the central bank policy and corporate earnings become key influences. We continue to see an asynchronous mid-cycle slowdown and not a recession as our base case macro scenario. Therefore, despite any near-term turbulence, we think investors should remain risk-on by overweighting equities in their portfolios. Thanks for listening. We hope you found this podcast useful. If you did, please do share this and other episodes with family, friends, and colleagues. For more information, please reach out to your contact at ADCB. You can also log on to our website at www.adcbam.com. You were listening to the Global Investment Insights podcast from ADCB Asset Management, and my name is Kishore Muktinutalapati.